Hi there, member. As a defined contribution member of the Bidvest South African Pension Fund, the Retirement Fund, or the Hybrid Plan, it is important that you understand the investment strategy of the funds and the investment choices you can make should you so wish. The intention of this video is to give you a brief overview of the strategy and the options available to you. It is very important that you obtain a copy of the fund's investment strategy booklet from your HR or salaries department. You are encouraged to read the booklet and to keep it in a safe place so that you can refer to it in the future should you need to. As a defined contribution member, your retirement benefit depends on the value of your fund credit. As you probably know, your fund credit is made up of contributions you make to the fund and the retirement funding contributions that the employer pays on your behalf to the fund and, very importantly, the investment return that is earned on these contributions. Investment choice is available to all members from April 1, 2018. If you do not make an investment choice, you will automatically be invested in the default life stage channel. As such, it is important to make sure you understand the operation of the default life stage channel and the other options available to you with regards to the investment of your fund credit. What is the default life stage channel, you may ask? Before I explain the default life stage channel, we need to understand that the aim of the funds is to try and earn investment returns above inflation. History tells us that the best way to achieve this is by investing a large portion of members' fund credits in so-called growth assets, such as shares, which are also called equities. The problem with shares is that although we expect them to provide the best investment returns over long periods, their value can, and does, go up and down a lot over a short period of time, and sometimes investment losses can be experienced. This is called volatility, and where you are in your work life, that is, are you close to or far from retirement, may determine how much volatility you can withstand. The default life stage channel looks to balance this risk and return at the different stages of your working life by slowly moving your fund credit to more conservative investment portfolios as you near normal retirement age. For example, if you are a younger member and you have a long time to go before you reach retirement age, you have what is called a long-term investment horizon, and you are able to ride out the ups and downs in the investment market. For this reason, you can afford to be invested in a portfolio that has a higher exposure to shares and the volatility we talked about earlier. If you are an older member and you are nearing your normal retirement age, you have what is called a short-term investment horizon. And because you do not have time to ride out the ups and downs in the market, you may want more certainty as to how much money you will have in the fund for your retirement. As such, you may not want to be exposed to any volatility, or you may wish to at least reduce your exposure to volatility. What we have just talked about, balancing risk and return for members at different stages of their working lives, is why the trustees decided to implement the default life stage channel back in 2012. The default life stage channel has two parts to it. The first part is for younger members who have a long-term investment horizon, and the second part is for older members who are within 6 years of their normal retirement age and have a short-term investment horizon. These two parts work in the following way. Part 1 of the default life stage channel. If you are more than 6 years from your normal retirement age, your fund credit is invested in the general fund portfolio. Of the fund's portfolios, the general fund portfolio is the portfolio that is expected over the long term to provide the highest investment returns, but with the greatest volatility over shorter periods. The aim of the general fund portfolio is to achieve a net investment return, net meaning after all fees have been deducted, that beats inflation by 5.5% per annum over periods of 7 years or more. You should note that this is the aim of the portfolio and that investment returns are not guaranteed. Part 2 of the default life stage channel. Once you reach 6 years from your normal retirement age, your fund credit will gradually be moved out of the general fund portfolio into the conservative and money market portfolios, so that at your normal retirement age, about half of your fund credit is invested in the conservative portfolio and the other half in the money market portfolio. The conservative portfolio is a balanced portfolio which aims, but does not guarantee, to achieve a return net of all fees that exceeds inflation by 3.5% per annum over 3-year periods, with a low risk of investment losses over any 12-month period. This portfolio is managed in a way that aims to achieve much lower volatility in returns than the general fund portfolio, but is also not expected to keep up with the investment returns earned by the general fund portfolio over long periods of time. In particular, the conservative portfolio generally has fewer risky assets such as shares and more in cash and other safer investments such as bonds than the general fund portfolio. The money market portfolio aims, but does not guarantee, to achieve a net return that exceeds inflation by 1.5% per annum over any 12-month period, with a very low chance of investment losses in any month. This portfolio invests mainly in cash and money market investments. This diagram shows you how the default life stage channel works. More than 6 years from your normal retirement age, your fund credit will remain invested in the general fund portfolio. In your birthday month, 6 years prior to normal retirement age, your fund credit will start moving from the general fund portfolio into the conservative portfolio. Automatic annual switches will take place over the next few years in your birthday month in order to slowly move your fund credit from the general fund portfolio to the conservative portfolio. When you are 2 years from your normal retirement age, your full fund credit will be fully invested in the conservative portfolio. 1 year from normal retirement age, your fund credit will be split equally between the money market portfolio and the conservative portfolio and will remain invested in these two portfolios until you reach normal retirement age. It is important to note that during the period in which the automatic switches take place, your fund credit will be invested more or less in line with the percentages set out in this chart, but the actual percentages are not expected to match the chart exactly. The reason being that the various portfolios, general fund, conservative, and money market, will perform differently on a day-to-day basis. Now that you know a bit more about the default life stage channel, you may ask the question, is this channel for me? The default life stage channel, as its name implies, is the default strategy for the investment of your fund credit. As I explained earlier, this means your fund credit will automatically be invested in this channel unless you choose to invest your fund credit in one of the fund's other investment channels. So it's important to make sure that the default life stage channel makes sense for you. The default life stage channel follows a strategy aimed at achieving returns above inflation without taking too much risk as you approach retirement. The design of the default life stage channel relies on certain general assumptions about how members will structure their retirement savings as they near retirement. If your plans around your retirement are very different to these general assumptions, then you need to investigate the other options offered by the fund. Assumption 1. You will retire at your normal retirement age in terms of your contract of employment. If you plan to retire much earlier or later than this, then you must be aware that you may need to make changes to the investment of your fund credit and consider the other channels which are available. We will come to these a little later. Assumption 2. At your normal retirement age, you will use all or part of your fund credit to buy a pension payable for life from an insurance company, and where only part of your fund credit was used to buy a pension, take the balance in cash. If, for example, you plan to use your fund credit to purchase a living annuity on retirement, then the default life stage channel may not be appropriate for you, and you may wish to consider investing your fund credit in either the living annuity channel or the own choice channel. Assumption 3. you have an average risk appetite. Although the default life stage channel experiences ups and downs in its returns, it is designed to be more conservative and less risky as you approach normal retirement age. If you think your fund credit should be invested even more conservatively, or, on the other hand, more aggressively and therefore more risk, then you can consider investing your fund credit in the living annuity channel or the own choice channel as appropriate. I expect you'll want to know what your options are if you don't want to invest in the default life stage channel. As I mentioned earlier, the default life stage channel is the channel into which you are automatically placed should you not make another decision for the investment of your fund credit. The trustees intentionally designed the investment strategy in this way as they understand that most members feel that they do not know enough about investments and do not want to make their own investment decisions. However, the trustees also accept that some members may be comfortable with making investment decisions and want to elect their own investment strategy and therefore should be able to do so within the portfolios and channels that the funds offer. So, if you are one of those members who feels comfortable making investment decisions and you decide to exercise investment choice, that is, you decide to opt out of the default life stage channel, then the choices available to you are the living annuity channel or the own choice channel. These choices certainly increase the flexibility members have, but you should not make any changes to the way your fund credit is invested unless you have taken suitable financial advice from a financial planner who is appropriately licensed to give advice in terms of the FAIS Act, the Financial Advisory and Intermediary Services Act. You can easily check whether your financial planner has the requisite license by looking on the FSB website using this address. Furthermore, in order to make an investment choice, you will need to obtain and complete the fund's investment choice form and submit it to the fund's administrators. We are going to look at the living annuity and own choice channels. If the default life stage channel does not tie in with your plans at retirement, then you can also consider the living annuity channel. This channel operates in a very similar way to the default life stage channel, but the switching process only starts when you are 5 years from normal retirement age. There are also only two portfolios making up this channel, being the general fund portfolio and the conservative portfolio. Your fund credit will be invested in more conservative assets as you approach retirement, but importantly, the living annuity channel has a higher allocation to more risky assets over the period to your normal retirement age when compared to the default life stage channel. This means that although the investment returns in this channel are expected, on average, to be higher, the chances of there being investment losses is also higher than if you were invested in the default life stage channel. If you're thinking of taking a living annuity on retirement, or if you wish to be invested in a channel that will potentially earn higher returns but will be more risky than the default life stage channel, then this channel may be more suitable for you. Let's look at what happens if you elect the living annuity channel. This diagram will help you understand how your fund credit will be invested over the period before your normal retirement age. Until 5 years from your normal retirement age, your fund credit will remain invested in the general fund portfolio. In your birthday month, 5 years prior to your normal retirement age, your fund credit will start moving from the general fund portfolio into the conservative portfolio. Automatic annual switches will take place over the next few years in your birthday month in order to slowly move your fund credit from the general fund portfolio to the conservative portfolio. When you are 1 year from normal retirement age, your fund credit will be split equally between the general fund portfolio and the conservative portfolio and will remain invested in these two portfolios until you reach your normal retirement age. Once again, It is important to note that during the period in which the automatic switches take place, your fund credit will be invested more or less in line with the percentages set out in this chart, but the actual percentages are not expected to match the chart exactly. The reason being that the general fund and conservative portfolios will perform differently on a day-to-day basis. We have now covered the living annuity channel and how it works. So, in summary, the living annuity channel, like the default life stage channel, will also slowly move your fund credit into more conservative portfolios as you get closer to your normal retirement age. But importantly, the living annuity channel, because it invests in more risky assets, is expected to be more volatile than the default life stage channel. The last of the channels which you can choose from is the own choice channel. This channel operates differently to the default life stage and living annuity channel in that you may decide to invest your fund credit in any combination of the general fund, conservative, and money market portfolios. For example, you could choose to invest your fund credits across all the portfolios as follows: 85% in the general fund portfolio, 10% in the conservative portfolio, and 5% in the money market portfolio. Or you may decide to leave your fund credit in full in the general fund portfolio. So, by electing this channel, you have complete flexibility within the options available as to how you invest your fund credit. The important thing to note, however, is that once you have elected the own choice channel, no further automatic switches take place, and it is your responsibility to ensure you are happy with the ongoing split of your fund credit between the various portfolios, and if not, then you must make the necessary changes by completing and submitting the fund's investment choice form. Finally, it is worth highlighting that if you are a long way from retirement, there is a lot of evidence to suggest that the general fund portfolio may be your best bet for achieving returns well ahead of inflation. For this reason, the trustees stress that younger members who decide to make use of the own choice channel must ensure they have taken suitable financial advice, including consideration of the possible long-term effects of switching out of the default life stage channel. We have now covered the 3 investment channels that are available to you in the fund. There are some general pieces of information that you also need to know. The most important one is that you are encouraged to obtain financial advice from a registered financial planner so that whichever channel or portfolios you elect meet your needs and risk profile. This is especially important if you decide to invest in the own choice channel. Your normal monthly contributions, any additional voluntary contributions, and any transfers into the fund will be invested in accordance with the channel you have selected. Remember that there are no costs if you elect the default life stage channel or the living annuity channel, but there are costs if you elect the own choice channel and move your fund credit more than once a year. You may switch channel at any time during your membership of the fund. For example, if you initially decided to invest your fund credit in the own choice channel, you may elect to move to the default life stage channel or the living annuity channel at any time thereafter. The details relating to the fund's investment strategy, costs, timing of investment switches, and what happens to your fund credit if you become a preservation member or a deferred retiree are included in the investment strategy booklet. This booklet is especially important as it also contains fact sheets for the general fund, conservative, and money market portfolios. These fact sheets are very useful in terms of understanding the investment goals and risks inherent in each portfolio, as well as providing details of the professional investment managers that look after the underlying assets on a day-to-day basis. In closing, let's recap. You're allowed to exercise investment choice, but this does not mean you need to exercise choice. If you do not exercise investment choice, your fund credit will be invested in the default life stage channel. This channel invests 100% of your fund credit in the general fund portfolio until 6 years from your normal retirement age, after which it begins to move gradually to a combination of the conservative and money market portfolios. If you feel comfortable making investment decisions and you decide to exercise your investment choice, then you can opt out of the default life stage channel and choose to invest your fund credit in the living annuity channel or the own choice channel. Please remember that the aim of this video is to briefly and simply explain the options available to you. The trustees recommend that you carefully read the investment strategy booklet, which contains more detailed information on the overall investment strategy of the funds. If you have any questions regarding the investment strategy, the default life stage model, or the investment choice options available to you, please contact your HR or salaries department.